Hello and Assalamu alaikum. This is me, Vishal Hassan, tutor for Advanced Audit Assurance, and this video is based on AAA technical article. So, firstly, let us revise the risk of material misstatement. Risk of material misstatement, or in short terms, I'll use ROMM. What is risk of material misstatement? And it may exist at the financial statement at the level of individual financial statement assertion. What are the assumptions, the claims, the sales? For example, management said that they have made a sales of 10 million. That means they're claiming that they have made a sales of 10 million. So, to understand where risk arises at the financial statement level, the auditor must identify significant classes of transaction and balances in which material misstatement may arise. So, where ROMM exists at the assertion level, this will arise through a combination of two types of risk: inherent risk and control risk. And both must be addressed if controls are expected to be relied as part of the overall assessment of the ROM. Inherent risk. Inherent risk, ISA 315 revised in 2019, identify and assess the risk of material misstatement. Identify, uh, identify five types of inherent risk factors: complexity, subjectivity, change, uncertainty, and susceptibility to manage bias or other fraud or risk factors. So you guys should consider whether these factors are present in the scenario provided to assist in identifying risk of material misstatement, that is ROMM. So first, you have to look at the spectrum of risk. The auditor will then assess where on the spectrum of inherent risk this risk sits. This requires an assessment of likelihood and magnitude of the potential misstatement. Significant audit risk are those the upper end of the spectrum of inherent risk. This will determine what is significant ROAM. Assessing the significance, risks which could not create material impact or which are not significant will not be capable of obtaining credit. Where candidates have asked to evaluate significant risk of material misstatement, judging what is or not significant risk is a crucial skill for auditors. And in the exam, the ability to make this judgment relevant to specific scenario critical to obtaining credit required to pass. Okay. So here is the example for you guys. The word example. A company has a newly purchased and highly material intangible asset such as a brand. The scenario, the issue is compounded by management who are under pressure to achieve a certain interest cover ratio or earning per share. The company has also purchased a plot of land for $3 million. So here, management will use their judgment to decide the useful life of the intangible asset. The purchase of land is factual, and unless there is evidence to the contrary, this will be stated at cost in the financial statements. Remember this. However, we have both judgment and management bias as inherent risk indicators in respect of the brand name. This is more likely to be a significant risk than land purchase. Assessment of the inherent risk is the first stage of identifying and evaluating significant risk of material misstatement. Now, control risk. And an assessment of control risk is also required in assessing whether this ROMM is likely to occur in financial statement. If there is information provided about controls in the scenarios should form a part of candidate's judgment and determine whether a risk is significant or not. Sometimes this will be at assertion level. For example of Winberry, September 2022. Then you can look at it. Information was given in the scenario regarding the valuation of inventory. Here you can see, I did it for you. Paste the information over here. A significant proportion of the groceries supplied by the Winberry are perishable products. The sale and storage of which is highly regulated through food safety regulations. Winberry Company employs experienced and food and product technology professionals to ensure that the company complies with all food safety legislation. Now, although these perishable items were significant proportion, right? Still they are significant proportion. They are the heavy risk items. The scenario stated that the items are monitored by experienced food and product technology professionals. The many candidates discussed this would be a valuation risk as the inventory may be obsolete. However, the scenario provides mitigation against this risk of valuation. The statement that the company complies with all food safety regulations also mitigated the risk that the groceries may breach health and safety legislation. So, still, what can be stated that there may be chances that some laws are overlooked or rare chances that inventory is over or understated. Okay. So then significant risk and identified and assess risk of material misstatement that the auditor's judgment requires special audit consideration. Candidates will be required to identify and assess those significant ROMMs in the context of the specific scenarios. Candidate may be asked to evaluate and prioritize significant ROMM arising in the scenario or to explain why significant ROMM has been identified. The separate article on the in the AAA exam related to this will be discussed later. Okay, and candidates can use the potential materiality of a misstatement alongside the inherent risk factors to help item assess which issue give rise to significant risk of material misstatement. So how to evaluate the risk? A significant risk once identified must be explained and evaluated in the context of the scenario. This often involves applying financial reporting knowledge to evaluate where and how the risk arise in the scenario. This may be supported by the movement in ratios and trends and incidences of possible management bias. In Winberry, September 2022, the scenario stated that data breaches might give rise to fines and from regulators. Management had not self-reported the breach in attempt to avoid and fine, though. Most candidates identified there was a ROMM associated with the recording and disclosure of the potential fine. Few evaluated how significant an issue this may be. One way to evaluate this would be to use the recognition criteria for provision. So here it is, data protection issue. 2 months ago, Winberry company suffered a cybersecurity attack in which the potential information of 2,500 customers, including their credit card details, was stolen. According to a representative of the audit committee, the company financial audit team had properly assessed the risk relating to cybersecurity, which is a requirement of the data protection legislation in the jurisdiction in which Winbury Company operates. The issue which lead to cybersecurity attack has now been resolved. Winbury Company did not make any reports of the breach to regulators. Now, here are the examples of the students who write nice answers, right? These are examples of good analysis which your prepared candidates have provided in the exam. Depth of which includes depth of evaluation, possible using the scenario specific information, application of judge. So these are demonstrations, as you can see. Given that the company do not wish to disclose the breach to the regulator, it is likely that a fine would be possible should the regulator be made aware of the breach. If the breach is not reported to the regulator and is not disclosed by any other party, then the fine is not probable. However, if it is possible, the regulator would be made aware, then there would be a contingent liability which would require disclosure in the financial statements, demonstration of the wider commercial aspects of the lack of disclosure, credit for commercial acumen was given. The disclosure of the contingent liability would effectively notify the regulator of the breach, making the likelihood of a fine more probable. Further actions relevant to the assertion and scenario, a reliable estimate can be made, okay, by reference to historic fines issued to other organizations for similar breaches. Hence, provision should be made. Demonstration of recognition of potential management bias, skepticism by the auditor. Management may be reluctant to provide for the fine as the reduction in profit as a result might mean interest cover covenants are breached. So, assessments of the scale and impact of the risk. There are assessments of the impact and scale of the risk on the financial statements. As a result, a provision might be omitted from the company liabilities and profits may be overstated. Okay, the amounts payable might be higher as a result of failure to self-report, which increases the impact of the misstatement. The potential impact of the understated expenses on the interest cover may make this material by nature. If it would result breach of covenants, then this demonstrated that the candidate had assessed the materiality of the breach and even without a specific figure being stated, management attitude and the risk of breaching the bank covenant are likely to make this risk material to the audit. Linking the risk to wider issues, management failure to self-report may give rise to concerns regarding management integrity, risk of material misstatement at the financial statement level. Therefore, reducing reliability of management assertion as a form of audit evidence. So, where more complex financial reporting is examined, such as those topics examined only at SPR level, additional credit will be available for the relevant underlying financial reporting knowledge, or where the candidates provide additional guidance on the relevant area of the financial reporting risk in the scenario. Now, audit risk. Audit risk is a combination of ROMM and detection risk. Detection risk arises where there is a risk that material misstatement may not be detected by the auditor, where a question requires audit risk. Both detection risk and ROMM should be considered. Some of these detection risks arise in special circumstances, group audits where the group auditor is reliant on component auditors, auditors where quality management or ethical threats may prevent the auditor from obtaining sufficient appropriate evidence. For example, in specialized industries where the audit team do not have appropriate specialized competencies, or where intimidation or self-interest threats prevents appropriate challenge of management. A lack of professional skepticism increases detection risk, right? The example of the audit risk or detection risk are opening balances, first time audit, a family based business, uh, seeking to list on stock exchange, right? Now, professional marks awarded in audit risk and ROMM questions typically fall into the following broad categories: analysis and evaluation, where candidates will be awarded a mark by prioritizing their most significant risks. This must be clearly stated. Simply saying significant risks include will not be awarded the professional skill marks. All the identified risks should be significant. So this is not specific enough. Stating that the most significant risk is or the two most significant risks are should be enough to obtain the credit, provided that the identified risk is a significant risk. Second, professional mm, skill mark is available or saying why that risk was selected. This may be justified based on the likelihood or the potential magnitude of material mistake. The mark here is for the demonstration of the evaluation to determine why something is important. There is no specific correct answer that the examining team are looking for, but rather a demonstration of the process behind the judgment. This can be demonstrated in conclusion at the end of the relevant requirement or through specific numbering and ordering of paragraphs. The former approach is likely to be easier for candidates in exam conditions. Professional skepticism and judgment. The skills will test the ability of candidates to challenge management accounting decisions and treatments or to draw conclusion on why risks are significant in the specific scenario as the identification of areas, risk and bias. Often examination team will allow credit for examining a specific risk of bias from the scenario and additional marks for drawing conclusion on the accounting treatment used by management. Skepticism is required to link risk and issues to management motives and consider the wider implication of the issue. Then we have commercial acumen. This skill can also be demonstrated through the evaluation of risk. Commercial acumen can sometimes be thought of the world as opposed to how the auditor thinks. For example, in a scenario assessing the risk arising in a group where a subsidiary has a year-end date a month earlier than the parent company, there are several risks arising in the group accounting implications of this situation. There are, however, further risks arising because the additional month of management accounts will make up the difference. Knowing that extra month will not have been subject to audit, as well as that the company month-end procedures are often less comprehensive than their year-end procedures, demonstrate a knowledge of commercial reality, and this would form part of the assessment of commercial acumen. So that's it. I hope you get it. If you have any comments, you can ask me, right? And also you can ask me in the comments, or you can contact me on my WhatsApp, which is 923341777706. And that's it for now. We'll see you next time very soon.